There's an old saying in the trading world: there are old traders and there are bold traders, but very few who are both old and bold. Many people believe that taking bigger risks automatically leads to bigger rewards. In reality, that mindset has destroyed more trading accounts than almost anything else. We're naturally drawn to the idea of taking bigger swings to achieve bigger victories. It feels exciting and it seems logical. But in trading, this way of thinking causes more damage than poor market analysis, bad timing, or emotional mistakes combined. In this video, we'll explore why aggressive trading feels so appealing, yet repeatedly ends in failure. We'll look at real examples of traders who learned this lesson the hard way, uncover the psychological trap that pushes traders to increase their risk after losses, and explain what truly separates consistently profitable traders from everyone else. Let's begin with the mistake that wipes out countless traders during their first year. You've probably heard this advice many times. Never risk more than 1 to 2% of your account on a single trade. And maybe your reaction was something like, "That's advice for people who are afraid to make money. I didn't start trading just to play it safe." That reaction is understandable. Risking only a small percentage can seem dull. It may even feel like you're limiting your earning potential. But here's where aggressive trading becomes dangerous. Imagine risking 10% of your account on every trade because you're highly confident in your strategy. Now picture experiencing 5 losing trades in a row. Almost half of your trading capital disappears. At that point, the financial loss is only part of the problem. The emotional damage is often much worse. Your focus shifts completely. Instead of searching for high-quality setups and following your plan, your mind becomes consumed with recovering what you've lost. You're no longer trading to grow your account. You're trading just to get back to where you started. That requires a completely different mindset, and unfortunately, it's driven by fear and frustration rather than discipline. Now compare that to a trader who risks only 1% per trade. After the same 5 consecutive losses, they've only lost about 5% of their account. Of course, they're disappointed, maybe even frustrated, but they're far from being in trouble. Their confidence is still intact, and they can continue looking for the next quality opportunity without the pressure of trying to recover a massive drawdown. One trader is simply trying to stay alive. The other is still in a position to keep winning. That difference alone changes everything. And here's an important mathematical reality many traders ignore. If you lose 50% of your account, you don't need a 50% return to recover. You need a 100% return just to break even. You've got to double the remaining balance before you're back where you started. On the other hand, if your account is only down 5%, recovering requires only about a 5% gain. One trader now needs an extraordinary comeback. The other simply needs a decent period of consistent trading. To understand why position sizing matters so much, let's look at the story of one of the greatest traders in history, Jesse Livermore. In 1929, Livermore achieved legendary status by shorting the stock market just before the historic crash. The profits he made would be worth roughly $1.5 billion in today's money. Just imagine that. He became one of the most respected and talked about traders of his generation. Financial newspapers followed his every move, and traders everywhere studied his methods, hoping to replicate his success. He seemed like someone who had completely mastered the markets. But only 5 years later, he filed for bankruptcy. How does someone go from controlling the equivalent of billions of dollars to losing everything in such a short period? The answer wasn't that he suddenly forgot how to analyze markets. His downfall came from poor position sizing. As his confidence grew, he began placing increasingly larger trades whenever he felt certain about an opportunity. A series of successful trades convinced him that he couldn't be wrong. He started believing that the rules of risk management no longer applied to him. Eventually, the market reminded him otherwise. His oversized positions led to devastating losses, and throughout his life he experienced financial ruin more than once. Before his death, Livermore wrote a heartbreaking statement. "My life has been a failure." Think about the weight of those words. This was a man who once controlled enough capital to influence entire markets. He earned more from a single trade than many people make in a lifetime. Yet he ended his life financially and emotionally broken because he repeatedly risked far too much. His downfall wasn't caused by a lack of trading knowledge. It wasn't because his market analysis was poor. It was because he failed to protect himself from unnecessary risk. And that same mistake continues to wipe out retail traders every single day. Here's what usually happens when traders become too aggressive. Understanding this cycle is important because it explains why even intelligent traders keep making the same costly mistakes. You take a large position, the trade wins. Instantly, your brain rewards you with a rush of dopamine. You feel unstoppable. You begin believing you've figured everything out. Naturally, you want to experience that feeling again. So on your next trade, you increase your position size even more. After all, if it worked once, why wouldn't it work again? Then the market turns against you. And here's the problem. Psychological studies consistently show that the pain of losing is roughly twice as powerful as the pleasure of winning the same amount. So instead of calmly accepting the loss, your brain becomes obsessed with recovering it as quickly as possible. Patience disappears. Clear thinking disappears. All you can think about is getting your money back. Instead of reducing your risk, you increase it again, hoping one or two trades will erase the damage. This is what's known as revenge trading, and it's responsible for destroying far more accounts than bad trading strategies ever do. Most traders don't fail because they can't identify profitable setups. They fail because oversized positions trigger emotional decisions that completely override their trading plan. Now compare that with a trader who consistently risks only around 1% per trade. A losing trade is frustrating, but it isn't emotionally devastating. They don't panic. They don't feel an overwhelming urge to recover immediately. Likewise, winning doesn't create an unhealthy sense of invincibility. Their emotions stay balanced. Their judgment remains clear. And in trading, clear thinking is one of your greatest advantages. The market has no concern for how you feel, but your emotions influence every trading decision you make. Keeping those emotions under control is one of the biggest reasons disciplined traders consistently outperform aggressive ones. Now let's look at a real-world event that perfectly demonstrates why position sizing can determine whether a trader survives or disappears. Think back to March 2020, when COVID-19 sent shockwaves through global financial markets. Panic spread everywhere. Stock markets experienced some of the most violent price swings in modern history. It wasn't unusual to see major stocks move 20%, 30%, or even 40% in a single trading session. Trading halts were triggered repeatedly as markets struggled to cope with the extreme volatility. The VIX, often called the market's fear index, surged to levels not seen since the 2008 financial crisis. For traders, it was one of the most unpredictable periods in recent memory. Now imagine risking 10% of your trading account on a single position during that environment. If the market moved sharply against you, and many trades did, you weren't just losing on that position. You could watch 30% or even 40% of your entire account disappear within hours. Not because your strategy was poor, not because your analysis was completely wrong, but because the market was moving so violently that stop-loss orders were often skipped, slippage became extreme, and positions lost far more than traders expected. I watched countless traders experience exactly that. Many believed their risk was under control. Then the market accelerated faster than their stop-losses could execute. Before they even had time to react, the damage had already been done. Now compare that with traders who limited themselves to risking around 1% per trade. Did they take losses? Absolutely. No trader escaped the volatility completely. But the difference was enormous. Even if the market moved dramatically against them, the overall impact on their trading account remained manageable. Instead of losing nearly half their capital, they might lose only a few percent of their account. Painful? Yes. Devastating? Not even close. And here's the part that many people forget. The market collapse didn't last forever. After roughly a month, maybe 6 weeks, markets began recovering. And they recovered much faster than many expected. That recovery created some of the best trading opportunities in years. The traders who had protected their capital were still in the game. They were able to participate in the rebound. And for many of them, those months became some of the most profitable periods of their careers. The aggressive traders never had that opportunity. Most had already blown their accounts. Instead of benefiting from the recovery, they were sitting on the sidelines, watching others capitalize on opportunities they could no longer afford to trade. Some will desperately try to save enough money just to fund another trading account. That's the hidden cost of excessive risk. It's not just the losses you suffer today. It's the opportunities you lose tomorrow because you no longer have capital to participate. The market doesn't care how confident you are. It doesn't reward conviction alone. It certainly doesn't care how accurate your analysis was. Extreme volatility has a way of exposing oversized positions, and when traders risk too much, those positions become the first casualties. Now here's something worth thinking about. Do you know how much professional traders typically risk on a single trade? Not social media influencers. Not traders chasing viral screenshots. I'm talking about professionals who manage millions or even billions of dollars. The majority of them risk somewhere between 0.5% and 2% of their capital on any individual position. Some of the world's top hedge funds and proprietary trading firms are even more conservative, risking as little as 0.25% on a single trade. Think about that. These are traders with elite research teams, sophisticated algorithms, institutional-grade technology, decades of market experience, and access to information that most retail traders will never have. Yet despite all those advantages, they still choose to keep their risk remarkably small. Why? Because they've learned one lesson that many retail traders ignore. Your first responsibility is survival. Without capital, there are no future opportunities. Every trade is simply another chance to stay in the game long enough for your edge to produce results. That's why experienced professionals don't measure success by how much they can make on one trade. They measure it by how consistently they can preserve capital while allowing profits to compound over time. One of the greatest traders to ever step into the markets is Tudor Jones. For decades, he's consistently delivered outstanding results, building a reputation as one of the most successful traders in modern financial history. Among his many lessons, one piece of advice stands out because of its simplicity. He once said, "If you have a losing position that makes you uncomfortable, the solution is simple: get out." At first, that sounds obvious, but there's a hidden truth behind those words. You can only exit a losing trade without hesitation if the amount you've risked isn't overwhelming. When your position size is reasonable, closing a losing trade is simply another part of following your trading plan. You accept the loss, protect your capital, and move on to the next opportunity. But when you've risked 10% or more of your account on a single trade, everything changes. That loss suddenly feels enormous. Instead of closing the trade when your strategy tells you to, you begin negotiating with the market. You convince yourself price will reverse. You widen your stop loss. You delay your decision. You hold on to hope instead of following your plan. And before long, what should have been a small, controlled loss turns into a disaster that damages your entire account. This is why oversized positions are so dangerous. They don't just increase financial risk. They make disciplined decision-making almost impossible. Now let's talk about something that doesn't get nearly enough attention. In fact, it may be one of the most expensive consequences of aggressive trading. When you suffer a massive loss, you aren't just losing money. You're losing time. And unlike money, time is something you'll never get back. Imagine your account loses 50% of its value. Even if you're a genuinely profitable trader with a solid strategy, climbing back to where you started won't happen overnight. It could take years. Years spent doing nothing more than recovering what you've already lost. Now compare that to someone who experiences only a 10% drawdown. Recovering from that is much more realistic. With consistent execution, they may be back at new highs within a matter of months. But the true cost goes even deeper than recovery itself. Every month you spend rebuilding a damaged account is another month you're missing out on one of the most powerful forces in investing and trading: compound growth. While you're trying to recover old losses, your capital isn't growing. It isn't multiplying. It isn't taking advantage of new opportunities. Every day spent digging yourself out of a deep hole is another day your money isn't working for you. Suppose blowing up your account forces you to spend the next 2 years getting back to your starting balance. You haven't simply lost 2 years. You've sacrificed 2 years of potential compounding. 2 years of profitable trades you never got to take. 2 years of market opportunities that came and went without you. That's a cost many traders never calculate. Aggressive trading doesn't just reduce your account balance. It steals valuable time from your financial future. And building lasting wealth requires time more than anything else. Consistent traders understand that real success isn't created through one spectacular trade. It's built through years of disciplined execution and steady compounding. To benefit from that process, you must remain in the market with capital available whenever opportunity appears. Every major drawdown pushes that goal further away. Every blown account resets the clock. And the unfortunate reality is that most people don't have endless years to keep starting over. They have one chance to build something meaningful. Protecting your capital is what allows that opportunity to remain alive. At this point, some traders will ask an important question. What if I catch a huge winning trade? Wouldn't risking more make far more money? It's one of the most common arguments in favor of aggressive position sizing. And on the surface, it sounds convincing. Let's say you risk 1% of your account on a trade that eventually delivers a 10-to-1 reward-to-risk ratio. That's an excellent trade. You've just grown your account by 10%. Now imagine risking 10% on that exact same setup. A 10-to-1 winner would double your account in a single trade. When you compare the numbers, the aggressive approach appears far more attractive. But there's one major flaw in that line of thinking. It assumes you'll actually survive long enough to reach that extraordinary winning trade. The reality is very different. No matter how skilled you become, your trading journey will include losing streaks. That's unavoidable. Even the best traders in the world experience periods where several trades fail in succession. Those losses are simply part of probability. To eventually capture one of those exceptional 10-to-1 trades, you'll likely have to execute hundreds, perhaps even thousands, of trades over time. And somewhere along that journey, you'll encounter difficult periods. If you're risking 10% of your account on every position, one ordinary losing streak can wipe out your capital long before that life-changing winner ever appears. Your account doesn't survive long enough to benefit from the opportunities you're waiting for. That's the hidden advantage of conservative risk management. It keeps you in the market. It gives you enough opportunities to eventually catch those rare, high-reward trades when they finally arrive. Because they do happen. Every experienced trader has seen them. But only traders who have protected their capital are still around to take advantage of them. Aggressive traders often eliminate themselves from the game before the biggest opportunities ever appear. They're so focused on maximizing a single trade that they never give themselves enough time to experience the long-term rewards their strategy could have delivered. One of the biggest advantages of keeping your position sizes small is something many traders never fully appreciate. It gives you psychological freedom. When you know that no single trade has the power to seriously damage your account, everything about your trading changes. You're no longer sitting in front of the charts hoping the market moves in your favor. You're not constantly checking every price fluctuation with anxiety. You don't find yourself staring at the screen, sweating over every candle, wondering whether you should interfere with your trade. Instead, you simply follow your plan. You identify a setup that matches your strategy. You execute the trade. You manage it according to your rules. And once you've done everything your plan requires, you move on. That's how professional trading is supposed to feel. Ironically, this emotional freedom often leads to better trading results. Your entries become more precise because you're no longer hesitating out of fear. Your exits improve because you're making decisions based on your strategy instead of your emotions. Following your rules becomes easier because every trade is simply another probability, not a life-changing event. Aggressive traders rarely experience this level of clarity. When 10% or more of your account is riding on a single position, remaining objective becomes almost impossible. Your emotions become deeply attached to the outcome. Instead of seeing the market for what it is, you begin seeing only what you want to see. You ignore warning signs. You convince yourself that your losing trade will eventually turn around. You move your stop loss because accepting the loss feels too painful. Sometimes you even close winning trades too early. Not because your strategy tells you to, but because you're desperate to lock in profits before the market has a chance to take them away. Eventually, fear replaces discipline. Your trading plan remains the same. Your market analysis may still be accurate, but your emotions slowly destroy your ability to execute consistently. And in trading, execution is everything. Even the best strategy in the world cannot produce consistent results if the trader refuses to follow it. There's another benefit to disciplined risk management that often goes unnoticed. It compounds psychologically. Every time you execute your trading plan exactly as intended, you reinforce good habits. Every time you respect your stop loss, manage your position correctly, and accept the outcome without emotional interference, you're teaching yourself to become a more disciplined trader. Over time, those repeated actions build genuine confidence. Not the false confidence that comes from a lucky winning streak. Real confidence. The kind that comes from knowing you can trust yourself to follow your process regardless of the outcome. Each properly executed trade becomes another piece of evidence that you have the discipline required for long-term success. Aggressive traders build the opposite habit. Their trading becomes driven by hope, then fear, then regret. Even when they make money, they often reinforce destructive behaviors. They remember the excitement of risking too much. They associate oversized positions with success. So they continue repeating the same dangerous habits until one losing streak wipes out months, or even years of progress. The emotional cycle never truly ends. Every winning trade creates pressure to risk even more. Every losing trade creates pressure to recover immediately. Instead of developing discipline, they develop emotional dependency on the outcome of every position. As the months pass, the difference between these two types of traders becomes impossible to ignore. One becomes calm under pressure, patient, methodical, consistent. The other becomes anxious before every trade, impulsive during every drawdown, and emotionally exhausted after every trading session. They're trading the same markets. They're seeing many of the same opportunities. Yet their experiences couldn't be more different. The difference isn't intelligence. It isn't strategy. It's their relationship with risk. That relationship shapes every decision they make. One of the greatest investors of all time, Warren Buffett, summarizes this philosophy with two simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first glance, those words almost sound too simple. But when you study Buffett's career, you begin to understand why they've remained his guiding principles for decades. He's been investing successfully for more than 70 years. Throughout that extraordinary career, he hasn't built his fortune by constantly chasing spectacular returns. He's built it by consistently protecting capital and allowing time to do the heavy lifting. Even during the 2008 global financial crisis, one of the worst market crashes in history, his portfolio experienced a drawdown of roughly 50%. Outside of exceptional events like that, most of his declines have been relatively modest. He isn't trying to hit a home run every quarter. His focus is avoiding the kind of mistakes that permanently damage wealth. That's exactly how successful traders think. Long-term profitability isn't built on a handful of extraordinary trades. It's built by surviving long enough for consistent gains to compound over many years. Compounding only works when your capital remains intact. Every massive drawdown interrupts that process. Every blown account forces you to start over. The traders who eventually achieve financial freedom aren't usually the ones taking the biggest risks. More often than not, they're simply the ones who stayed in the game while everyone else kept restarting. Their greatest advantage wasn't making extraordinary returns. It was refusing to destroy the capital that allowed those returns to accumulate year after year. In the end, successful trading isn't about proving how much you can make on one trade. It's about ensuring that you'll still be here to take the next 100 trades. Because that's where consistency is built. And consistency, not excitement, is what creates lasting wealth. Let's bring all of this down to earth with a realistic example. Forget the flashy social media posts showing traders doubling their accounts overnight. Let's talk about what long-term success actually looks like. Imagine you begin your trading journey with $10,000. You're a competent trader, not a market wizard, not someone who wins every trade. You still miss opportunities, make mistakes, and experience losing streaks. You're simply someone with a profitable strategy who understands the importance of protecting capital. Instead of chasing quick riches, you commit to risking only 1% of your account per trade. Your growth isn't spectacular. Some months you earn around 3%. Other months you finish with 7% or 8%. Occasionally, you barely make a profit at all. And every now and then, you have a losing month. But despite those ups and downs, your account keeps moving in one direction over the long term, upward. After your first year, your account has grown to roughly $14,000. It's not enough to quit your job. No one's calling you a trading genius. Life looks much the same as before. But something important has happened. You've proven that you can trade consistently without destroying your account. By the end of the second year, your balance reaches approximately $20,000. Now your progress starts to feel real. You begin trusting your process because you've seen it work over an extended period. Year 3 arrives, and your account climbs to around $30,000. The growth is becoming noticeable. Friends and family who once doubted your commitment begin asking questions about your trading. Another year passes. Your account approaches $47,000. You haven't taken reckless risks. You haven't gambled your future on one oversized trade. You've simply remained disciplined while allowing your gains to compound. By the 5th year, your account has grown to around $75,000, possibly more if you experienced a particularly strong year. Will numbers like these go viral on social media? Probably not, but there's something far more valuable. They're sustainable. You aren't losing sleep over every position. You aren't checking your phone every 5 minutes. You aren't living under constant emotional pressure. You've built your account steadily while maintaining peace of mind. Now compare that journey to the trader who believes aggressive risk is the fastest path to success. Many of those traders never even make it through their second year. Some blow up their accounts during the first 12 months. Others survive a little longer but spend most of their time rebuilding after major losses. Instead of compounding wealth, they're constantly trying to recover what they previously lost. By the 3rd or 4th year, many are exhausted. They're emotionally burned out. Some convince themselves trading doesn't work. Others decide the markets are manipulated. Many simply quit. Meanwhile, the disciplined trader continues doing exactly what they've always done. Trade. Protect capital. Compound gains. Repeat. While everyone else is restarting from zero, they're quietly building genuine wealth. There's nothing glamorous about it. You won't see headlines saying, "I made $47 this week by managing risk responsibly." That kind of story rarely attracts attention, but it's the story that creates financial independence. Consistency doesn't generate excitement. It generates results. And that's what truly matters. There's another cost of blowing up your trading account that most people never consider. It's not just the money you lose. It's the opportunities you never get to participate in afterward. Think about the incredible market recovery that followed the COVID-19 crash. Think about the explosive growth of artificial intelligence companies in 2023. Now think about whatever the next major market opportunity will be. History tells us there will always be another one. The problem is this: those opportunities don't wait for you. Markets continue moving whether your account is funded or not. If you've already blown up your capital, you're forced to watch those opportunities pass from the sidelines. While disciplined traders are growing their accounts, you're trying to save enough money just to start trading again. That's one of the greatest hidden costs of aggressive risk-taking. The market doesn't pause while you recover. It keeps creating opportunities every single day. But only traders who still have capital are able to benefit from them. I've seen traders spend 5 years blowing one account after another. Every time they begin making progress, they increase their position size. Eventually, they hit another losing streak. Their account collapses. The cycle begins all over again. They spend months rebuilding. Then another setback arrives. Another account disappears. Another restart. Year after year, they repeat the same painful pattern. During all that time, disciplined traders continue compounding quietly in the background. Those traders participate in every major market move because they're always prepared. They're never forced to sit on the sidelines waiting for another chance. Imagine where someone could be after 5 years if they simply stopped blowing up accounts. Instead of constantly rebuilding, they might already have a portfolio capable of changing their life. Instead, many aggressive traders end up exactly where they started, or worse. Frustrated, bitter, convinced the markets are impossible to beat. They tell friends that trading is nothing more than gambling. They insist the system is designed against retail traders. But in many cases, that isn't the real problem. The market didn't defeat them. Their own approach to risk did. Trading itself isn't what failed. Aggressive trading failed. The markets reward consistency. They reward patience. They reward traders who continue showing up day after day with capital still available to deploy. The market has no sympathy for someone trying to rebuild after another blown account. It simply continues creating opportunities for those who survived. And survival has always been the first requirement for long-term success. Success in trading isn't usually determined by finding the perfect indicator. It isn't about discovering a secret entry technique. It isn't about predicting every market move correctly. More often than not, profitable traders and losing traders see the exact same opportunities. The difference lies in how they manage themselves. The market doesn't demand perfection. It demands discipline. It rewards patience. It rewards traders who respect uncertainty and protect their capital, even when they're convinced they're right. Every trade you take should be viewed as just one event in a long series of probabilities. No single position should have the power to determine your future. The goal isn't to win every trade. The goal is to remain in the game long enough for your edge to play out over hundreds, or even thousands, of trades. That's how consistency is built. That's how confidence is earned. And that's how real wealth is created. If there's one lesson I hope you remember from this video, it's this. Your greatest edge in trading isn't your strategy. It isn't your indicators. It isn't your ability to predict the market. Your greatest edge is your ability to survive. Because every successful trader has losing trades. Every successful trader experiences drawdowns. Every successful trader goes through difficult periods. The difference is that they protect their capital well enough to still be around when the next opportunity arrives. Trading is not a race. It's a journey measured over years, not days. The traders who build lasting wealth aren't usually the most aggressive. They're the ones who remain disciplined while everyone else burns themselves out chasing shortcuts. Protect your capital. Respect your risk. Stay consistent. Because in the end, surviving the market isn't just part of becoming successful. It's the reason success becomes possible in the first place.